Welcome back. Tonight on my special edition, late night, not as like the one from last night. Tonight we are actually going to talk about capital gains. What are capital gains? Capital gains are not ordinary gains. So, for example, if you have stocks and then you sell it, that would be a capital gain. And then they can be classified further into long-term and short-term. And how do you identify the difference between the two? The holding period. More than a year, less than a year. Less than a year, short-term. Now, how's that taxed? That's taxed at your ordinary income rate. So your ordinary income bracket. And if it's long term, then you have your 0, 15, 20. So, and then there's a range on that. I don't have the details with me. So, what is the purpose of this video? So, is it safe to assume that everyone, essentially everyone, is in the market right now? So, what I'm getting to is, a lot of people are probably day trading. They're probably in some crypto or some starts with a T or an A. Well, Amazon, Apple, Tesla, or they're trading futures, contracts, forex, things in that nature. So if you're trading and you're making some big gains, expect to pay some taxes. So in this video, I want to give you a possible strategy that could possibly work. Remember, this is not financial advice, legal advice, or any sort of advice. This is just for information, for entertainment purposes only. So, what can you do if you have huge gains, just multi-baggers? What do you do when you sell those and actually lock in those gains? What can you do to mitigate your tax situation? Well, I want to tell you one way. In theory, when you have those capital gains, you should be able to now reinvest those proceeds into opportunity zones. So what's opportunity zones? Opportunity zones are areas that are designated by the U.S. government to qualify under special rulings where you get special tax breaks if you hold if you put cash money investment into these areas and hold it for a certain period of time, whether it be 5, 7, or 10. So at 5 years, you get to increase your basis by 10%. 7 years will be 15%. In 10 years, you will mark it to whatever fair market value is. So essentially, it will be a tax-free play. All right, so you can also see this as the QOF, Qualified Opportunity Fund. And again, you need to put cash money into the actual investment to qualify. So if you are borrowing money to help finance the overall purchase, only the cash portion is going to be eligible for the tax breaks. The borrowed money will not qualify. Again, don't quote me on this. This is just in theory, remember? All right, so for example, you put $10,000 into the market. Your positions went up, whether it be stocks, whether it be options, whether it be crypto. It goes up to 100 grand. Let's say 110 grand. So now you have $100,000 of gains. So if you were to be in the 20% capital gains, well, that's if you held a long term. In this market today, I don't think a lot of people is holding for a long term. So let's just say you're taxed at ordinary rates, or your effective tax rate's gonna say, let's say 25%, right? So at 25% and you have $100,000 gains, that's $25,000 in taxes. So that means you're gonna net $75,000 after you take out your 10K. So we're looking at $100,000 of capital gains, and in this case, short term. So it will be taxed at ordinary rates. And so that would be your effective at 25% roughly. So that's $25,000 in taxes, federal taxes. All right. Okay. So what you do is you will now move that proceeds into a opportunity zone, and then put that into a qualified property. And then from there, the first part of this is going to be considered the tax deferral part of the strategy. So that means that you're just deferring the taxes, right? Okay. Next part is now you hold it into the 5-year mark. And so now you get to increase your basis by 10%, and that essentially now increase your basis, and that extra 10% will be tax-free if you choose to sell at that point. So 100 grand plus 10%, that's another 10,000. So now your basis is effectively at $110,000. And if you hold 7, it becomes 15%. And then if you hold at 10, whatever it is, 150, 500, 1,000, it becomes mark to market, pretty much fair market value. So in essence, in theory, now when you sell it, your basis is equal to your sell price. You won't have any gains. So now you went from a tax deferral strategy into a tax elimination. So it's good to know, right? Another segue is if you were to now move your money into the qualified opportunity zone and let it sit to defer those taxes at some point in the future, whether it be 1, 2, 3, whatever, how many years. Now, if it appreciates astronomically, now you can actually utilize the CRT, which I have a video that I made in this channel last night. I have to make a video tonight. So I made a video. I just got back from a dinner, but yeah, so I'll leave it at that. So if you were to move the appreciated property into a CRT, what's going to happen is you're going to identify a charity of your choice, that is qualified charity of your choice. And from there, you will identify how much money or cash flows you are trying to receive over a period of time, no more than 20 years. And the remainder has to be at least 10%. And all that calculation, discounting it, that cash flow stream. And then from there, calculating your charitable deduction amount. And again, to figure out what that value is, you need to figure out the layers of your income tax bracket. So from top to bottom, and that's how much that's how you convert it into the actual value that you're saving. So let's recap. So you got stocks, you sold it, and it's short term. So now you have this huge capital gains. You can move those proceeds into opportunity zones and now defer those taxes to some future point in time, which now this part of the recap, I'm segueing to a third strategy. So say this year you have earned income from W-2 or from your business, so you're going to be in a higher tax bracket. So now you can move those proceeds into an opportunity zone, qualified property, and park it there. And there's a couple benefits. One, you're going to get a return on your money, or you should, right? So depending on how you invest it, it could be a direct buy of a property, real property, inside a opportunity zone, or two, you could invest into a fund. But usually when you invest in the opportunity zone fund, you have to be an accredited investor. So that's just to be aware that those options exist. I'm not going to go into the details. But so when you park it in there, literally you wait for the year and you time to see which year in the future your income is going to be a lot lower. And then you start looking for exits. So that when you exit out of it, it's at the 5-year mark. Well, you increase your basis, so your taxable piece of it will be reduced. Second, you also have appreciation. Now that could essentially cover some of the taxes. Third, you actually have cash flow streams in the years leading up to the exit year. And ultimately, in the year that you exit, essentially you could be making a lot less money. So now your brackets could be a lot lower. So now again, you save in tax. Appreciate you tuning in. Hit that like, please subscribe, because I'm gonna drop some content. I don't know. You be the judge and let me know what you think. Or if there's a situation where you're like in the mix, we can explore together. And in theory, I can like share what I think could be, but it's just my assumption, not advice again. So appreciate you all tuning in, and until next time, be safe and take care.